So thanks everyone for joining us today. It is just Andy and I. Lowell is out on vacation this week, so we're holding down the fort for the Q2 economic and market review. We're already at the midpoint of 2024 and have a lot of exciting topics to cover. A lot of great questions came in ahead of time, so I'm going to handle more of the macro, economic, general market themes through the last quarter and really the first part of the year. We'll talk a little bit about some of the big things happening in the second half of the year, and then Andy's going to cover more in depth on the strategies, changes, and observations we've made on that front, and then we'll leave plenty of time for questions. So again, I just had this pulled up, but if anyone thinks they might want to throw in a question at some point along the way, you can scan this QR code with your phone and that'll pull up the app we use, Slido, and you can type in your question there, and then it'll filter through, and we'll be able to see everything. But in terms of the quarter in general, from a general market standpoint, it's was a pretty, let's call it, quiet quarter in the context of a really exciting start to 2024. So across the board, major asset classes, posted fairly average returns, nothing really out of left field. Q1 was really strong, especially for equities. This past quarter, a little quieter, a little quieter from a market standpoint, a little more exciting from an economic headline standpoint, which we'll get into. Emerging markets was the leading pocket of the global equity markets in terms of returns, up about 5%. U.S. market was second in line, up just over 3%, and a pretty flat quarter for the bond market. So a lot of this and what's happened so far this year has led to questions around, hey, what's happening? Should we be concerned about how well things are going, essentially, right? It's been a couple of years of really strong returns. Is it too good? Should we be anxious? We keep hearing all-time highs. Literally like 30 seconds before we started this webinar, I got pinged that the S&P, clipped above 5,600 for the first time. We've hit 36 new all-time highs so far in 2024. If that trend were to continue, that would put us just over 70 all-time highs on the year, which is astronomical in historical context. Just for comparison's sake, I think the record was 77 all-time highs in a year, and that happened in 1995, obviously in the middle of a really strong run for the stock markets. And so that's really, the main, theme from a just market level perspective. It's just been not a whole lot of volatility, a lot of upward movement. So we're getting a lot of really good questions around, well, like, what does that mean? And should we start to be concerned that some sort of a pullback is imminent, which we'll get to. But just zooming out 1, 5, and 10 years, the general trend the last few quarters has been about the same. You see, the previous rolling 10 years, slightly above average equity returns for the U.S., well below average equity returns for the rest of the world. And we've all seen what the bond markets experienced the past couple of years, which with what has happened with interest rates. And so I understand, a lot of our clients are heavy equity investors. A lot of our clients also are invested in other asset classes. So they're not just in stocks. They've got some fixed income and they've got potentially some alternatives if they're in one of our asset allocation models. And I wanted to point out, Andy and I released a piece just a couple of weeks ago. It's a pretty deep dive on our asset allocation model. How we think about diversifying portfolios, what tools we use, and why. That's on our website, and it's going to get re-released in an upcoming newsletter. But I think it gives some really good perspective around the way that we approach balancing portfolios, and also we know the traditional retirement portfolio of some percentage in stocks, some percentage in bonds. Those investors have really been hit hard with the issues in the bond market the last few years. So that piece gives a really good under the hood look at what we're doing that's a little bit different and how our clients have benefited for it. So that's been, really exciting for us. And this is a great time before I get into some of the other pieces related to market movement and headlines. When we hit these points where things are feeling good, markets are, meeting or exceeding what we would expect their returns to look like over the short run. This is a really great time to call time out and revisit, what level of risk am I taking in my portfolio? Is it still appropriate? Are there any life events that are upcoming that I need to be planning for and potentially think about either reducing risk or further balancing my portfolio? So that's exactly why our team is here. These are really the times to be having those conversations when things are, feeling, okay, volatility is mild and anxiety levels are relatively low. Now's the time to think and revisit that. Maybe you confirm you're doing the right thing, but that's exactly why our advisors are here to make sure we stay front and center on that conversation. And so, what's been interesting about if you look at what's happened really from the bottom of this current bull market in at the end of 2022 up until now, you haven't gotten that feeling of frothiness or over exuberance either from retail investors or especially institutional investors. So one thing that caught our attention this quarter is if you look at a survey, JP Morgan did a survey of institutional money managers, and they ask them a question, are you more likely to increase or decrease equity exposure over the next coming days or weeks? And it's a really good pulse check on the big money movers and what they're planning and what they're feeling in terms of just sentiment on the market. And this is the most current reading on this, showing only 17% of these institutional managers were looking to add to equity exposure. And you see similar readings on the retail side when you see like the fear and greed indices. They're all kind of reading around neutral. You don't get that sense. It's still been a very questioned rally. You'll notice this indicator specifically was polling, high above 70 right before 2022 happened. So we haven't had that mad dash towards stocks that a lot of people would usually expect in the later innings of the bull market. So in terms of just the general sense and feel of where people are, it's been interesting to notice that like it really hasn't caught on to either institutional or retail investors that this is really a bull market that they can believe in. And but I think you can make a lot of arguments that that's what's helped sustain, a lot of the upward, movement in equities as people are, filing in one by one, trying to participate. We've also had a really long time. It's been a while since we've had a 2% daily drop in the S&P, which really I think leads itself to the type of volatility we're not experiencing right now. So it's been 345 days since we've had a 2% drop in the S&P. You can see that there's periods where we've gone much longer than that. And there's also periods where there's been a lot more volatility, especially when you look at 2020 through the end of 2022. But it's been this kind of slow climb, especially since the bottom of the last bear market we've experienced. And volatility's been overall fairly muted, teamed with pretty muted sentiment. And, we get this question, we've been getting hit with this question a lot around, should we start getting nervous about how well things have been going for stocks? And this is something we've shared before. It's refreshed quite often, and it's always a great data point to show, okay, if I go back, 100 or so years, how many periods were there, was the market in an uptrend, and in how many periods did we experience bear markets? And in this case, we're defining bear markets as a top to bottom drop of 20% or more. This just, if you didn't even want to be a numbers person and worry about the numbers, you can see that these bluish trends are a lot more prevalent and more larger in magnitude than these little red blips that happen along the way. So it's actually, if you look at things on a calendar year type basis, a little over 75% of the time we're in an upward trending market, and the other quarter or so of the time we're experiencing the normal volatility you'd expect in order to achieve those higher returns. Um, so this bull market is not overstretched by any historical context. It has been going on for, coming up on a couple of years. It's been doing so in the context of some headlines that haven't felt completely comfortable. We get it, especially in an election year. There's still and has continued to be, stuff happening, globally in terms of geopolitics. And, the markets had to weather that, but this is essentially what you would expect and experience as a long-term investor. And even within any given calendar year, something we haven't experienced yet, this year and did just briefly and barely last year is your run-of-the-mill annual correction in stocks. So when clients ask us, how are things going? Should we be concerned? We kind of break that out into two different sub questions. One is, should we expect some sort of a pullback or correction this year? And the answer to that for us is always going to be, yeah, you should. It would be completely healthy to see a 15 or 10% pullback at some point, through 2024, as we've experienced in many other years. You can see here, most calendar years, even when the December 31st closing returns are strongly positive, had some sort of a drawdown in the months between January and December. This year so far, we had a little bit of a 5% drawback in April. Last year, we barely hit 10%. And then obviously in 2020 and 2022, we saw things that looked a lot more significant. So when you think about, what is our general outlook for markets in general, we would define a 10 or 15% correction to be completely healthy. You could argue in a bull market, that's what you'd want to help keep things level and cool as things are in motion. But our expectation at this point, based on just the general trends of the economy, inflation coming down, and the corporation and the consumer both still doing really well, that this is a, let's call it modestly growing economic backdrop where consumers and businesses are hanging in there. So for us, outside of any major left field event like we saw with COVID or something that's completely out of the ordinary, our expectation is that the general backdrop is still really strong. And with all the talk of new all-time highs, like I said, we've hit 36 of them this year. In 22 and 23, we only hit one. So now when these new all-time highs start to rack up, especially in a short window of time, we get peppered with questions, does a new all-time high mean I should be nervous? Is this a bad thing? And we would actually point to the data to say that it's the exact opposite. New all-time highs are actually a bullish indicator and not a bearish indicator. This, I think, visually represents that really well. It's going back to the late 80s. So we're clipping on 40 years of recent history here to show, how does investing at an all-time high on a forward-looking basis, what are the returns generated there look compared to just picking any random day of the week or a month to invest in stocks. And we discussed this a little bit in the last webinar, and we used a different visual to support it. But in general, this really speaks to just how market momentum works and, how, gains and trends tend to follow one another, especially in the short run. But you are, statistically speaking, in many instances, you're positioning yourself better by investing in an all-time high than you are at any other point. So for those that have, cash that has been sitting on the sidelines, especially with the rates coming down, yields falling, and, those short-term options looking less and less attractive. If you have long-term money that you've been waiting to invest and put to work, we would argue, and the data would support that now's a good time to at least have the conversation to consider that in a diversified way. So the market itself is, despite some of the headwinds, on pace for continued success and strength. And the other big, let's call it the elephant in the room for this year, being the election that's happening in November. We get a lot of questions around election season and even the years leading up to elections around what does this mean for the market? Should I be concerned if X versus Y gets put into office? We're going to do a post both of the conventions in August. We're going to be doing a essentially an election special where we're going to do a dedicated presentation just on investing in the economic and market climate and election years. And Andy, what's the I had the date. It's the end of August, right?
Yeah, it's the end of August. So it's that last Wednesday in August, August
The
28th.
28th. Okay, so that'll be August 28th. We're going to send the invites out with our upcoming newsletter so people can preemptively register. But I wanted to throw something up here related to specifically market behavior during an election year and then the subsequent year following an election through previous administrations, and see and support what we've said through many previous election cycles, that despite a lot of the personal feelings that get attached in the election season and a lot of the media coverage and attention that elections draw, the markets and economy are incredibly resilient. There's a lot of essentially an unlimited number of levers that can be pulled to move an economy, and it's very hard for a single person, even a president, to do and sway, the economic machine essentially. So you notice that election years and post-election years are typically fairly, let's call them strong, if not average, for stocks. So you notice a lot of different types of presidents in here, different tenures, reelection, not being reelected. But overall, and what we'll continue to communicate, especially through year end and support with data, is that um, elections themselves, there's a lot to unpack and discuss, but as it relates to the markets, it's essentially not an intermediate or long-term market mover. So we're excited to pull that together and have more conversations there. But Andy, I'll pass to you to talk more strategy.
Sure. So let me know if this sounds familiar. We're halfway through the year, and the majority of returns from the stock market have come from the Magnificent Seven stocks. Like, is this 2023 or 2024? It feels like we're running back the script from last year. And in some ways, it's even more extreme than that. If you look at the last 6 months return differential between the market cap weight version of the S&P 500, which is the one you see quoted on Yahoo Finance and CNBC, versus the equal weight version that just gives all the stocks the same weight, there's a 13 percentage point differential between those two, which is as extreme as it ever gets. NVIDIA alone accounts for 1/3 of the 15% return in the S&P 500 year to date. And, when you consider, on an equal weight basis, it's just 0.2% of the entire index. It's pretty extreme there. So sure, we've seen the Magnificent Seven stocks get back to dominating. But I do want to point out that if you look across all the different size levels here, so large, mid, and small, you see growth stocks are outperforming value stocks across the entire spectrum. And, small growth is actually positive, whereas small value is negative. And I want to point out one particular section, which is mid-growth stocks, which have really performed quite well, relatively speaking, both year to date and over the rolling, 12-month period. Even outperforming, other large stocks, the large value stocks. So it's the second best performing area of the market over these time frames. And I know there's a lot of talk about how the Russell 2000 has been disappointing and it hasn't done anything. It's been 668 days since that index last set an all-time high. But I do want to point out, when we talk about our investment strategy and we're shifting between large caps and small caps, we say large and small really to simplify the messaging. But really what we're saying is large and non-large. And when you look at the market cap weighting of mid-cap stocks and small cap stocks, mid-cap stocks do have more market value than small caps. So, when we've been tilting our portfolios away from some of these larger names, the major area where we've leaned into is that mid-growth cell. And that's been a big time driver of returns because that has been a strong area of the market. It hasn't been as strong as Magnificent Seven, but it certainly has been contributing to return. So I think that's a kind of a nuanced point that gets sort of overshadowed. I think mid caps as a whole sort of get overshadowed because we talk about the S&P 500, that's large caps. We talk about the Russell 2000, that's small caps, and we leave out that middle group of stocks oftentimes. But that's been an attractive area to invest in. And certainly, as we move along here, the mega cap outperformance is nothing new. In the 2020s, outside of 1 year, which was 2022, this group of stocks has simply outperformed the rest of the market. And I know that this has some people concerned about market concentration, but one thing I wanted to point out in the next visual here is that there are plenty of times in the past where we've seen market concentration at these levels. If anything, we've kind of just gone through a time period where the market concentration was lower than it had been previously, and we're sort of just getting back to where things were earlier in the 50s and 60s. And so it's nothing unusual to see this type of market concentration. It certainly doesn't look like an historical outlier, even though it is different from the market that we've just gotten through. And I will say it is different too than some of the other periods where we had market concentration, like .com, where there wasn't much in the way of market fundamentals. These stocks that are concentrating in the market here, the fundamentals have been really strong, and in fact, it's the fundamentals that have driven them. If you look back in 2022, the Magnificent Seven stocks actually went through a bit of an earnings recession, and so their decline that year makes sense. But coming out of that, earnings growth has been fantastic. And so, when we see these types of stocks make the types of moves that they're making, it's because the results are there and they're actually living up to the lofty expectations that the market sets for them. I think, this kind of segues with Adam's discussion earlier about the lack of frothiness in the market. If we were to see the Magnificent Seven move based on just multiple expansion, price multiple expansion alone, we'd be a little bit concerned about the frothiness of the market, but it simply hasn't been the case. They've just performed really, really well. I think one of the most interesting things, though, when we look out forecasting things into the future, we see this begin to level out. And what we're seeing here on this chart is the Magnificent Seven versus all the other stocks in the S&P 500 that aren't the Magnificent Seven stocks. And we're seeing that lower 493. The expectations are that it's going to catch up with the Magnificent Seven, as the Magnificent Seven should see some of those earnings results decline a little bit. So Yahoo Finance, actually, good timing, just had an article that they published today about the earnings recession and the S&P 493 being over. And it looks like that. It's probably like our read on that is it's probably bullish for the rest of the S&P 500. So we do like to see greater market breadth than we've seen this year, and it looks like that there's a good possibility that we see that. And so while large caps always do comprise the majority of our model, even when we say we're leaning towards large caps in our investment strategies, we're still tilting the majority of the money into large caps. But it has been the case recently, as we look in the most recent time frame in this chart, that we've seen large cap stocks as a whole go back the other direction. So what we like to show this chart, I like to call it the wave chart, because you see how cyclical size and style phases are through the years. And basically what we're looking at here is when the market when you see the gold colored lines on this chart, over the last 3 years, large cap stocks have outperformed small cap stocks. And when you see the blue, over the last 3 years, small cap stocks have outperformed large cap stocks. And what you can see here is based on the historical pattern, we would have expected more of a small cap phase to materialize than what we actually saw. We just saw things tick barely above into the blue where small caps are outperforming, and then it goes right back down. But I think one of the interesting things here is that the Magnificent Seven stocks are so big, and the data we're seeing here is market cap weighted, that it really kind of hid a more true small cap phase. So on the next chart, we're going to see this, where if instead of looking at the market cap version of these indexes, we looked at the equal weight version, we saw more of what we would expect to see out of a small cap phase. So over the 3 years post, the COVID market crash, small caps did have a good run. We talked about it's been a magnificent 7 game versus the lower 493. Mid and small caps did better than the S&P 500 as a whole if you give every single stock the same weighting over the 3-year period. And it looks like it's about the same magnitude that we would expect historically and for the same length of time that we would expect historically. And just recently, though, we've seen the inverse be true, where it's the rest of the stocks, the S&P 500 stocks that are larger, have outperformed the small and mid cap. So we're seeing momentum swing pretty suddenly back towards that group. And so the implication here in our size and style responsive US equity strategy is we're responding to the price movement in real time. And we've actually just reset our targets from 60% large back up to 70% large. So I just wanted to make that point, as that's something that we just did change. The other piece of that, it's size and style responsive. The other piece of that is growth. And, it's the same chart here, but gold means growth is outperforming and blue means value is outperforming. You've seen us be pretty reactive, be pretty on the ball about this. In 2022, we were leaning into value. Growth really struggled, and that value lean really helped our portfolios hold up relative to the market. But early in 2023, we saw momentum begin to swing the other way back towards growth, and so we moved portfolios in that direction. And the pro-growth momentum has been quite strong ever since. And so, you can see here that, we've got a pretty high degree of conviction that we are right in the middle of a growth phase. And so we're sticking with that growth lean in portfolios right now. So nothing's changing as far as the style bet. And I think one of the things from a macro standpoint that bolsters our confidence in this is that we're expecting the Fed to begin cutting rates. I think that this is a big question that people have had on their minds, investors have had on their minds for a while. Initially, expectations were for a June rate cut, and that obviously got pushed out because the inflation data early in the year was a little bit hotter than expected. But more recently, we've seen some better signs for the Fed. And the first thing is we've seen some of the real-time measures of GDP begin to show not like recessionary conditions, but cooling conditions. And keep in mind, this is what the Fed wants. They've raised interest rates so that they can splash cold water on the economy to try to further get inflation under control. So GDP falling a little bit, but hopefully not going into a recession is what the Fed aims to do, and we're seeing signs of that. And I think the other piece here is recent inflation data has come in softer again. So, there were reasons to believe that the higher than expected inflation readings in the first half of the year were, just for short-term reasons, and it looks like that has been the case. So the market right now is pricing in the first rate cut coming in September and a second one coming in December. If you look at Goldman Sachs and their prediction, they're predicting the same thing, and that this is going to be the start of a major cutting phase, with the terminal rate being somewhere in the low 3% as inflation continues to fall. And so, I think the upshot here is that this should be bullish for growth stocks, because historically, when we see interest rates falling, growth stocks outperform value. And, it looks like that's the type of market environment we're about to get ourselves back into. So, all that's to say is we're quite confident that growth is where we want to be, at least for the foreseeable future. All right, and with that, we did want to make sure we left time for a Q&A session here at the end. And we both asked for questions at sign up, and I saw plenty of you did ask us questions. We've loaded those into the tool here. Keep in mind, you can always scan this QR code that you see on the slide if you want to get in here and ask questions as well. It'll flow through. Adam and I will see it, and we'll be able to answer the questions. So I've organized some of the questions that came in initially. We had some that were along the same lines, so we'll kind of answer them in groups, I think, and move forward. And so there were actually a few questions this time about gold and different ways of accessing gold in portfolios. Like, is it a good idea? I think this probably has something to do with people possibly being worried about markets being all-time highs, and are there ways that we can diversify that? So the first thing here is there are people who there's different ways that you can access gold. You can do it directly through ETFs, or another way that people do it is by investing in gold mining stocks. And so I think we got this question last time and it's been asked again. But are gold miners a good investment? You know, I would say that you have to be careful there when looking at, you know, like a specific set of stocks. Just because you're investing in a gold mining company doesn't mean you're actually going to get the performance of gold. Um, and you know, if you look at the range of outcomes over the last 6 months, the worst performing gold miner was down 58%. The best performer was up 85%. So just a massive range. I think it's a little bit risky if you're trying to pick specific gold mining stocks. And I also looked at this, and our stock selection model actually does not have a single gold miner rated as viable right now, with a average expected alpha of negative 2.3%. So I would say, you know, gold miners, be careful there. You know, the other question that we get sometimes is, does it make sense to invest in gold? And I would say that this is something that we do look at when we look at our asset allocation models. We include, you know, we try to include all the different types of investments that we can when we're talking about investing in fully diversified portfolios, and commodities, including gold, make the list of possible investments, but they never get chosen for our asset allocation models, because you typically see gold have returns that are lower than stocks, but volatility that's significantly higher than bonds. And so, you know, just that risk reward trade-off isn't there, and the correlation to equities is still, you know, pretty high. So you're not really getting a whole lot of diversification there. And the other thing is, you know, people will say, okay, that's fine, but this is going to be my inflation hedge. And, you know, we look back to 2022 when we saw inflation spike, gold was negative. So it doesn't always even work as an inflation hedge. So it's not included there. Do you have anything to add to that, Adam?
No, agree. Volatility of a stock, but the return of maybe a bond in a good year. So it's a trading asset, similar to crypto right now.
Similar to crypto right now. That's a good segue to one of the other questions we got, which was about gold and Bitcoin. And so you probably hear out there, people will refer to Bitcoin as digital gold. And there are some similarities to that. You know, for one, both gold and Bitcoin do not have any cash flows. You know, so that, you know, makes it a little bit tricky to evaluate from a traditional finance standpoint. And they also, you know, I guess, benefit from scarcity. There's only so much gold out there in the world. With, you know, Bitcoin, there will only ever be so many many coins. But the problem we have with Bitcoin is it's so volatile. It's, you know, probably the most volatile thing that you could possibly own as an investment. And, you know, it is true that it's easier to access today than ever before with the Bitcoin ETFs that were approved earlier this year. But we're not including it in asset allocation models, and we don't recommend it for client portfolios because of the extreme volatility. I know this is your favorite topic, Adam, the topic of Bitcoin, but did I leave anything out there?
Yeah, no, nothing else there. I think you nailed it.
Okay, great. Um, So like I said before, I think the thing that's maybe prompting some of these questions is, you know, the market's at all-time highs. Maybe there is some concern about, you know, what our stock's going to do. So we got a question about, are we seeing anything that would indicate the start of a downturn or recession? So I'll let you maybe tackle this one first, Adam.
Yeah, the short answer is no. There's no major yellow or red flags going off at this time. You only have to point a few directions to really get confidence there. You know, number one, the consumer is still in a record, position in terms of the strength of the household balance sheet. I know we've spent down some of the COVID era savings, but the average American is in a better position than they've been in a long time. If you look at the amount that families are paying on things like debt service, that's at a record low. So just your average family, despite inflation and other headwinds, is still on a relative basis, doing really well. Corporations are really doing extremely well. You look at the last few quarters of S&P 500 earnings, it's been a lot of mentions of just like earnings growth and strength, and we're only 4 or 5% in the earnings reports for this quarter for the S&P, and you've got most companies that have reported so far have beat or exceeded expectations. And so, your average, large, mid, small companies doing well. And then finally, the economic, just like the general economic indicators in terms of like inflation coming down, the labor market is still strong, although I know there's a lot of attention being put on the unemployment rate ticking up, to just over 4% based on what happened last week. But that is more of a normalization of the labor market after some like really, um, excessive strength for a meaningful window of time. So cooling off is actually, you can look at that as a positive. And then lastly, your average worker, inflation adjusted earnings, are running forward. So people's, their wages are increasing at a rate that's now exceeding the rate of inflation. So when you add all that up, I think you can say that even if things are slowing, they're still strong, and we wouldn't see any immediate recessionary signals. Do you have anything else, Andy, on that?
Yeah, I mean, you pretty much nailed it. I think the type of recessions that are always scary are the ones that are like 2008 or 2020 with COVID, something that is unforeseen that comes out of left field. Now, in this case, people have been calling for a recession since 2022 began and inflation spiked. And the Fed, in a lot of ways, is trying to slow the economy down. Like the problem has been that things have been growing a little bit too fast for them. And by holding interest rates where they are, they're trying to cool things down. So it's sort of like a controlled burn, so to speak, to try to stop a larger forest fire. And so I don't think that this would be something that really has major implications for investors. Of course, there always could be something that comes out of left field that none of us are seeing right now. But at this point in time, I'd agree that that things have really been better than expected. The economy's been better than a lot of people hoped for, and I think that's absolutely a positive. One of the things that I thought you did a great job discussing in your section, Adam, was about the whole section about is the market frothy? Should investors be nervous just because we're at all-time high? So we had a couple questions. I think we had one come through the chat with through Zoom about how we're planning for a potential downturn, and we had a similar question come through about are we making any changes about being defensive in the portfolio? So you threw out some good numbers, so I definitely don't want to belabor the point there. But I've got a few other numbers here that I just wanted to highlight. And so the S&P 500 you mentioned is just ticked over 5,600 today. Do you know what it was at the start of 2020? 3,300. The start of 2010, it was at 1,100. At the start of 2000, which is arguably one of the worst times you could possibly invest at the top of the bubble, it was at 1,500. And if we go all the way back to 1990, the S&P 500 was at 340. So, you can see that when you look out with a decades-long time horizon, the S&P 500 should be making gains. You could have been scared in 1990 at 340 that things were at all-time highs. But if you held, you're at 5,600 today. So that's pretty good. One more question. Do you know what the average return of the S&P 500 is the year after it makes an all-time high?
12%.
Yeah, 12.7%. Yeah. So, just because the market's at all-time highs, I don't think that there's any reason to get defensive. I think honestly, if that happens, you're probably making a mistake in leaving returns on the table. I do think though, when it comes to managing risk, and certainly whenever you invest in equities, we've got clients who are 100% in stocks. We have clients where it's a lower percentage and it's a more diversified asset allocation. So I think our answer to if you're concerned about stocks might be to evaluate if is your current asset mix appropriate for you. So Adam, how do we go about that discussion with clients?
Yeah, well, there's two inputs that go into that decision. The first is going to be more quantitative. It's what rate of return do you need to generate to get from point A to point B? A lot of people like to benchmark to what is the S&P historically yielded, or what kind of returns could I get in an aggressive type portfolio. But if you look at, what just like your assets and your liabilities and what you want to be living off of for the rest of your life, that equates to a number. So your portfolio has to generate some level of return so that you can comfortably meet your standard of living between now and the end of your life, essentially. So that's known as your required return. So what return do I have to generate to get from here to there? And then the other piece is more like a gut check, like how comfortable am I with the ups and downs of the market? Some people, when the market falls 50%, get really excited and want to invest, and they understand that volatility might mean opportunity. Other people might be at a point in life when they say, if the market falls another 20-30%, if that happens again, I'm not going to feel good, and I want to avoid that to the best I can. And so marrying those two pieces, and it's unique for everybody, those two inputs will equate to a certain portfolio on the risk spectrum. So that might mean, and sometimes it means discussing trade-offs, right? Those two inputs might not talk to one another in a clean way, but that at least gives us a point for a conversation to determine, okay, what are some options we have to balance the portfolio so that both of those pieces make sense? And a lot of these questions really lend to that. People ask the question, how long is this rally going to continue? What are we due for a pullback? I mean, they might be asking that for different reasons. Maybe you're thinking about retiring. Maybe you've got a change in circumstances, or you want to spend more money and draw more from the portfolio. So I think really asking the question, if I'm concerned about the market today, what might be driving that, and then how do we revisit the portfolio to discuss a potential change? And like I said earlier, now's the time to do that. You want to be having that conversation in a time like today, and not in a 2020 or 2022 when things are chaotic, and the anxiety level is up. So that's what I would say, and that's exactly why our advisors are here to have that conversation.
Yeah, and one thing I want to be perfectly clear on is our philosophy with our US equity strategy is that we're not going to get defensive. We're going to be invested 100% in stocks all the time. We're not going to make moves to cash. We will adjust to the size and style market phase as we see it changing, but we're always going to be allocated to stocks. So that means that, we expect a 10% correction once a year. We expect a 20% bear market about once every 5 years, and we're going to be fully exposed to those experiences. And from our view, volatility is the cost of the excess returns that you can achieve by investing in stocks. And so you kind of have to be exposed to those periods, those tough times, to be able to achieve the long-term, returns promised there. So yeah, certainly, if that type of risk, is a little bit too much, that's what our financial planning team is here for. And now is a great time to have that conversation, as you mentioned, Adam. So on this topic of our asset allocation models, you mentioned that we just recently, you and me, published a blog post on our website. I actually thought it got, we look at the metrics behind the scenes for all of these things, email open rates, and people who actually read the blog and go there. And it was one of the highest read pieces that we've put out ever. So it certainly did seem to strike a nerve. And so we've got some questions about that. So specifically, this one is about alternative investments that are in our portfolios. One of the things that we pointed out in our blog post is that, one of the areas where we're different from what you might see out there as the rule of thumb standard advice is that we do have a pretty heavy allocation to alternative investments. And that's an area that can mean a lot of things. That could mean something as simple as direct real estate, or it could mean something like Bitcoin that's really out there on the risk spectrum. And that's really not what we're talking about. When we talk about alternative investments, the reason something would enter our portfolio Sure, it'd be nice if we could get a return boost for it, but the primary reason why we're including alts is for the diversification benefit. So really, with any alternative investment, we want to see low correlation to stocks and bonds because that can, keep returns, where they are, but lower the risk of the portfolio, and then that results in a better experience at the end of the day. So we get higher risk-adjusted return. And so the specific alternative investments right now in our allocation models that we're using that achieve those goals is something called managed futures. That's a fully liquid alt. It typically is a mutual fund format. And essentially what that does is it's a trend following strategy that can go long or short stocks, bonds, commodities, or currencies. So because it can potentially access any of those asset classes and can go long or short, it has a lot of diversification processes or properties. And specifically, it has great performance as like delivering crisis alpha. So you'll see a big downturn in the market, like 2022 is a great example of that. Stocks entered a bear market, but if you're in a balanced portfolio, you're saying that's okay, I prepared for this, I've got a big allocation to fixed income, that's going to be the buoy in my portfolio. But in 2022, bonds also entered a bear market at the same time because the Fed was really aggressive in raising interest rates. So my stocks are down 20%, my bonds are down 18%. It seems like there's nowhere to go. Managed futures as an asset class was up double digits in that year. So it was the piece that was helping shield against risk in the portfolio. And the other piece that we use when we talk about alternatives is this asset class called private credit. So this is basically big asset managers act as lenders. Crucially, they're not banks, and because they're not a bank, there are companies that either because they don't want to or just because they're not big enough to get decent terms from a bank will look to these private credit funds to access capital. And so what you get typically is floating rate interest, which means that private credit was a really good diversifier for public bonds in 2022 because, 2022, you could have been invested in the safest bonds out there, US Treasuries, and you would still experience losses. So, you're not taking on default risk, but you're taking on interest rate risk. And so even though you're invested in very safe US Treasuries, let's say it's a 10-year time horizon, you still saw losses there because it's a fixed interest rate. With private credit, it was diversifying to public bonds because it was floating rate. So as rates rose, public bonds prices fell, but the private credit was able to reset those interest rates at higher levels. So it was able to achieve better returns there. So nice and diversifying. That's what we like. Its risk profile is probably more like high yield bonds because you are taking on more default risk. And so how do we handle that, Adam? Kind of like that trade-off and risk in our asset allocation portfolios.
Well, you assign essentially a risk score to any asset you want to enter into a portfolio. So when you think about the framework for building an asset allocation, it all is driven around the idea that you want to include various asset classes that all contribute something a little bit different and bring something different to the table. And essentially for each level of risk, you assign a risk budget. So if we want to set a level of predictability in terms of the ups and downs of a specific risk level, we need to make sure that the two pieces are talking to one another in the way that they need to. So if we're going to take, let's say, more risk on the stock side of the equation, we need to make sure that the fixed income, the alternatives are complementing that. We don't want to be in a situation like a lot of people found themselves in 2008 and even in 2020 where they thought they were diversified, but all the pieces kind of fell together at the same time. So it's a matter of understanding the credit profile and the risk profile of each different new entrant into the portfolio and staying true to that premise that, hey, if we're building a moderate risk level portfolio, we want to make sure that in a worst case scenario, we've got a reasonable expectation of how much downside risk is possible. So, and that's ever changing, right? That's why, we pretty much look at this every quarter and revisit it, and we'll add and subtract pieces to the puzzle based on changes and things like interest rates, like we did in 2021 and 22, or just other dynamics related to these investments in the economy.
Yeah, great topic. Let's stay on this topic of asset allocation models and I guess, things that aren't 100% equities. And so we've got another question that I'm going to push through here, that is about foreign holdings and how we should handle those. And the U.S. stock market has outperformed the global stock market materially over the last 15 years now. So how do we handle foreign holdings in our asset allocation models?
Well, I think we generally as investors have a home team bias. We not only us as Americans, but like people in other countries, you tend to overweight your equity exposure based on the country where you reside. So it's very common for us to run into investors that have almost all their portfolios in U.S. stocks. The global market is broken down more to the tune of 60-40, meaning our market represents about 60% of the global market. The other 40% is developed and emerging markets outside our border. And historically, what's happened, and it's kind of like a game of ping pong, right? So there's windows of time where the US outperforms. There's windows of times where international outperforms. We're in a historical stretch right now, really over the last 15, almost 20 years of domestic equity outperformance to the rest of the world. So those with international diversification have, let's call it, been penalized to a degree because through most of that 15-ish year stretch, the US has outpaced the rest of the world by a sizable margin. So the big question has just been like, well, when's that going to turn? We're still believers that international exposure makes sense. Of our equity buckets currently, it was about 30% of the equity allocation. Now it's been reduced to 20. So we still have a, let's call it a meaningful exposure outside of the US, albeit at a lower level. And in our post, we kind of outlined some of the key reasons for that reduction. A big one being continued trends in demographics, especially as it relates to developed economies. The demographics here in the US are stronger. And then also, if you look at what's happening on the tech side with things like artificial intelligence, we're investing heavily and leading in those areas by a wide margin. However, and the reason why we keep some exposure overseas is that it's very possible that changes. You're seeing other countries, specifically over in Europe, that are getting really aggressive trying to attract talent, such as engineers for things like AI and creating incentives to compete with the US. So we want to be prepped for that, but still, if you look at just the general trends, we still want that heavy overweighting domestically.
Yeah. And we just made a few changes as far as international goes, maybe especially with emerging markets as well, both equities and debt. Can you kind of talk through some of those changes and the reasons for it?
Yeah, so we're pretty much about an even posture now between developed and emerging markets. EM especially, they've got some demographic tailwinds that are in their favor. Their populations are younger. They're creating a lot of the goods and services that we're using here domestically. Their equity evaluations are also more attractive. So their markets are cheaper by a lot of metrics compared to developed international and US. And so there's opportunity there. We want to make sure we're positioned to take advantage of. And then, emerging markets debt was a new asset class for us. A lot of focus has been on treasury bills and cash the last couple of years. But EM, dollar denominated debt, gives us access to not corporate, but sovereign level emerging markets bonds that have slightly higher yields, but are tied very closely to our interest rate regime here in the US. So with the higher yield and policy that's kind of benchmarked to what we're doing here domestically, we think that and came to the conclusion that there's a lot of forward-looking diversification benefits from EM debt specifically. So we're excited about that being part of the models now.
Yeah, absolutely. And since we're talking about debt, we had a couple questions about public fixed income. And I think specifically, we have two questions here that are very similar in nature. So I'm going to highlight both of them for a little bit as we talk through this. So we covered in our presentation that we do expect the Fed to cut rates as soon as September. And so this is going to have implications potentially for the bond market. So the big we've made some rebalances, like over the last couple of years. Actually, we've done quite a bit more trading in the bond market than I ever thought we would do. Can you talk about our most recent change there, Adam, and why we're making that move?
Yeah, I think bonds, especially when we first put our asset allocation models in place, our stance at that time was that, the outlook for bonds, at least in the short and intermediate term, was pretty bearish. Yields were low, the case for equities was still really strong, and it really felt like if the economy held up, that there was really nowhere for rates to go but up. Um, so for a long time, we kind of held an underweight posture on fixed income. And as rates rose through 2022, we made a lot of changes within our fixed income allocations on top of that. And once the dust settled and we were sitting around that 5% short-term Fed funds rate, we kind of started to look forward and said, well, you know what? The outlook for fixed income has actually improved relative to where it was when we first thought this through in 2017. And so we got more and more comfortable with fixed income as part of our model, specifically intermediate term fixed income, which had not been part of the equation leading up to that point. And so, again, as part of that revisiting of the asset allocation and which pieces should go in and what magnitude, the forward-looking risk return outlook for bonds starting at a higher yield level, and with the rates coming down, sooner rather than later, we thought the return, not only was there a return and yield element to fixed income, which had not been there several years prior, but the diversification benefits against equities was looking a lot better.
Yeah, absolutely. I think, we've made this move to, like, we've changed the duration of the fixed income bucket. We were, previously intermediate term. We didn't want to take too much risk there and go long term, so we were intermediate term. And then in the face of those rising interest rates, went really short term with it. And now we've gone back out to intermediate term, as our preferred posture. And the way I think of it, it's almost like, you're locking in these higher rates, for a longer period by being intermediate term today. And you should get the benefit of price appreciation for when the Fed does begin cutting rates. So, I think you want to be moving out from short term to intermediate term before that first rate cut happens, and that's what we're doing across client portfolios. I've got one more
And
question
Andy,
here.
even if they don't cut rates, like let's say we're wrong and rates
Mhm.
and there's not a rate cut, you've still got a great starting point for yields,
Yeah,
especially with cash. And we're trying to encourage people to extend duration out of cash in an intermediate fixed income because those
yeah.
yields are higher. And let's say we have a higher for longer environment, that's not a terrible place to be.
Right, absolutely. Yeah, I mean, with the short term, type T-bills, there's no guarantee that in 6 months you can still get that same rate. So absolutely agree, with that. So I've got really, I think we've got two more questions here, unless anything else comes through. There's one question that was simply sector rotation, so I'm gonna have to do some interpretation of what we're asking about here, but it's just an opportunity for me to reiterate what we try to do with our size and style responsive U.S. equity strategy. Basically, we're looking at the momentum in large versus small stocks and the momentum in value versus growth stocks, and then we're setting that as a target for our portfolios. Right now, we're leaning into growth, and we've just begun to move a little bit back up to large cap stocks based on recent price momentum there, even beyond just the Magnificent Seven stocks. So that's where we are. As far as how that trickles down to economic sectors, we're always going to be invested across all of them. So everything from communication services to utilities, we're going to have an allocation to this lean. I will say this lean into growth and into large caps does lead us a little bit more heavily into sectors like information technology than we previously were. But we're basically trying to neutralize the impact of economic sectors, and we're just taking whatever the market neutral one is there, based on our size and style targets. And the last question, you covered in pretty good depth here. And maybe all we can do here is tease, but you see the three questions that we have all asking about what's going on in the election and how it might impact the portfolio. I will say we are doing a deep dive, webinar on this on August 28th. We wanted to get to, past both of the conventions, and have a really solid idea of, of what the outlook looks like for the election itself. But since you covered this in your section, Adam, I don't know if we want to spend too much time here, but, do you have any closing thoughts on this?
No, I think the data will support the politics, might have meaning in other places, but as it relates to the market, it's not a major needle mover. Actually, if you go even down to the sector level, it's really funny. If you look at certain presidents and you try to guess like what sector would do really well under this administration, and usually it's that the opposite happens. So
Right.
even when a president has like a very specific policy that might impact a very narrow pocket of the economy, those stocks even don't always do what you think they're going to or should do. So
Yeah.
I think we'll be prepped with a lot of good data. We'll have like the full picture at that point, and it'll be close to election season, and we'll make sure we take lots of questions there. But I don't imagine the picture to change in terms of the messaging.
Yeah, it's always interesting how that works. Gun manufacturers did great under Obama. Clean energy did great under President Trump. And then fossil fuels did great, currently under President Biden. So, it's funny. It's so hard to predict what the stock market's going to do in response to who's in charge. But yeah, we'll go into all of this in much more detail. Again, that date is August 28th for that webinar. All right. Well, I really appreciate everyone joining us here today. I don't see any other questions, so we're going to go ahead and end it here. I do appreciate everything, everyone and their attending. We had pretty good attendance here. I think I saw 57 people at the peak here, which is good. And I know we had more than that who signed up. We will be sending out a replay of this to your inbox. So please feel free to take a look at that. And you can always forward that out to any friends and families, people who you think may be interested in any of this content. So I appreciate everyone joining us, and we will talk next time.